Many fintech and digital lending app firms are in a tizzy after reports of the government banning about 138 gambling apps and 94 loan apps came to the fore a few days ago. Today, the RBI governor too clarified, stating that the MeitY ministry, that's the Ministry of Electronics and Information Technology, has asked the Play Store to remove apps that are not regulated by RBI, and that it wasn't RBI who recommended a ban on any apps. Listen in.
These apps वो आरबीआई के रेगुलेटेड एंटिटीज नहीं है. हमारे जो रेगुलेटेड एंटिटीज है, जो मतलब आरबीआई का सर्टिफिकेट ऑफ रजिस्ट्रेशन है, वो प्राइमरीली एनबीएफसीज है. इन टर्न एनबीएफसीज कई सारे एप्स यूज करते हैं. तो हम वो जो एनबीएफसीज है उनसे हमने एक लिस्ट मंगवाया कि कौन कौन ऐप जो, बिकॉज काफी सारे इलेजिटिमेट इलीगल एप्स भी है जो कि अपने आप अपने आप लेंडिंग करने की मतलब प्रॉमिस करते हैं, मोबाइल में मैसेज भेजते हैं, जो कि कोई भी एनबीएफसी सेक्टर का मतलब नो एनबीएफसी सेक्टर हैज अपॉइंटेड देम. तो एनबीएफसी सेक्टर के द्वारा जो एनबीएफसी इस लेंडिंग बिजनेस में है, डिजिटल लेंडिंग में है, उनके द्वारा जो जो ऐप वो यूज करते हैं उसका लिस्ट हमने गवर्नमेंट को दे दिया है. उस बेसिस पर गवर्नमेंट ने ये कदम उठाई.
जैसे आपने बोला, हमने किसी डिजिटल लेंडिंग ऐप का बैन तो बोला नहीं है. व्हाट वी हैव डन एक्चुअली इज आई थिंक मिनिस्ट्री वी हैव शेयर्ड द लिस्ट ऑफ एप्स व्हिच आर यूज्ड बाय द एंटिटीज रेगुलेटेड बाय आरबीआई with the ministry. Ministry has, I think, requested the Play Stores to remove these apps which are not what you call operated by the regulated entities from the Play Store. So that is the position as it stands today.
Now let me bring in Anurag Joshi, who's joining us for more on what exactly is happening with these apps. Why are these apps facing a sudden ban, Anurag?
Digital lending apps that were recently barred from operating by the government are not regulated by the Reserve Bank of India. Central Bank Governor Shaktikanta Das said today, speaking to reporters after raising the benchmark repo rate by 25 basis points, Das said that the RBI does not regulate these apps, and in fact what the RBI does is that it is regulating the non-banking financial companies, and RBI had asked some of the NBFCs to share details about those apps which they own and operate, which in turn were shared with the government, and the government took the decision of blocking some of these digital lending apps. Now, the Economic Times had reported earlier this week that the government had banned 94 digital lending apps and several online betting platforms. Now a final decision about blocking of the apps rests with the Ministry of Electronics and Information Technology and the Home Ministry, both of which are in discussions about finalizing the matter. And in fact, the Ministry of Electronics and Information Technologies is also having a parallel and separate discussion with stakeholders in the digital lending app industries to gather feedback before the government gives its final decision on the matter.
It's the decision everyone was keenly awaiting, and it's the first RBI policy outcome of 2023, wherein the RBI has gone ahead and hiked the repo rate by 25 basis points to 6.5%. This was widely expected, but Governor Das also said that more policy action is warranted as they see inflation above the 4% range. The central bank, meanwhile, sees FY23 GDP growth at 7%, and its forecast for FY24 stands at 6.4%. The policy stance remains focused on withdrawal of accommodation. 4 of the 6 members voted in favor of the move. This move will have its repercussions with increasing EMIs, home and auto loans as well. But what does it say for the economy? Before we speak on that, let's listen in to what Governor Das said.
Assuming an average crude oil price Indian basket at $95 per barrel, inflation is projected at 6.5% for the current financial year, that is 2022-23, with Q4 at 5.7%. On the assumption of a normal monsoon, CPI inflation is projected at 5.3% for 2023-24, with Q1 at 5%, Q2 at 5.4%, Q3 at 5.4%, and Q4 at 5.6%. Headline inflation has moderated with negative momentum in November and December. But the stickiness of core or underlying inflation is a matter of concern. We need to see a decisive moderation in inflation. We have to remain unwavering in our commitment to bring down CPI headline inflation. Broad-based credit growth, improving capacity utilization, government's thrust on capital spending and infrastructure should bolster investment activity. According to our surveys, manufacturing, services and infrastructure sector firms are optimistic about the business outlook. On the other hand, protracted geopolitical tensions, tightening global financial conditions, and slowing external demand may continue as downside risks to domestic output. Taking all these factors into consideration, the real GDP growth for 2023-24 is projected at 6.4%. I repeat, the real GDP growth for 2023-24, that's for the next financial year, is projected at 6.4%, with Q1 at 7.8%, Q2 at 6.2%, Q3 at 6%, and Q4 at 5.8%. The risks are evenly balanced.
All right, to speak more on this, I'm joined now by Indranil Pan, Chief Economist of Yes Bank. Madhvi Arora, Lead Economist at MK Global, is with me on the show. And I'm also speaking with Vivek Kumar, Economist at Quant Echo Research. Welcome to all of you, and thank you so much for joining us on the India Development Debate. Mr. Pan, let me begin with your take. Is it safe to say that we're beginning to see the end of the interest rate hike cycle? This was the 6th in a row. It's 25 basis points as was expected. But what are you reading between the lines? Is this whole time of increasing interest rates now slowly going to come to an end?
Reaction to your question is, I don't know. And possibly the governor also doesn't know. In between the line reading, I think the governor would be looking for a very decisive drop in inflation. The data that we see today, the deflationary trend of the vegetables is definitely over in January. So there will be a little bit of bounce in the inflation in January compared to the December reading of 5.7%. So that's not a decisive drop in inflation to start with. Secondly, I think the guidance in terms of the real repo rate that we are looking at seems to be changing. We had been given to understand by Dr. Patra that it was possibly at an 80 to 100 basis points is the real gap that they were looking at. But today, the governor did allude to the fact that even as real rates are positive now, it is still lower than the pre-pandemic level. So we really still do not know what is the approach that the RBI would take so far as the real rate is concerned. Having said, the overarching comment remains on core inflation and how core inflation could be sticky, which necessarily means that a sustained drop towards the 4% can still be missing. I personally would be looking at another 25 basis points, not necessarily in April, because they might actually want to pause and take a look of this on the 250 basis points and how it impacts the market. The overall inflation to say. But having said that, the other critical factor is that if they are more positive on the growth, the higher growth, especially from the demand side dynamics, doesn't provide you with any disinflationary momentum going forward.
But if you look at the inflation projections for FY23, you are down, not massively, but down from 6.7 to 6.5%. For FY24, it's 5.3%. Madhvi Arora, technically within that tolerance band of the RBI. So is the case for, I would say, going slower on the rate hike cycle being made? more clearly now, or like Indranil says, one doesn't really know, and nor does the governor perhaps?
With Indranil on that front. So even though we are looking at inflation coming off, a part of it is obviously because of the base effect. And near term, I think inflation will still be a more sticky story, at least as far as core is concerned. As we go ahead into FY24, my sense is that while headline inflation will be in line with the Reserve Bank's forecast, I think core could be a tad lower than 5%. But nonetheless, it is still higher than the 4% that the committee anyway wants to achieve on a more medium-term basis. And of course, I think to a large extent, the kind of policy pressure that is coming is emanating from the Western central bank's reaction function, or the kind of, rate repricing that is happening around the world at this point in time. I think to that extent, policymakers around the world are not wanting to be, committed to any kind of a rate path as such, and they want to have that flexibility in hand wherein, they can take a call with regard to whether they should pause at that point in time or probably go ahead with a much higher rate hike. Of course, they understand that the monetary policy lags will also play its part, but I think to a large extent, the sort of fluid global market that we are in, I think it makes sense for any policymaker at this point in time to tread a little cautiously before committing to a pause or a trajectory of a rate hike or a rate stance in general. And that is one of the reasons why I think that the policymakers are now sort of shying away from the whole real rate terminology that they had talked about 6 months ago, and are wanting to keep that flexibility with regard to the stance, which they haven't changed as yet.
True. The unpredictability of this entire financial year is there for everyone to see. But Vivek Kumar, in terms of factors which would probably boost, the propensity to hike rates, the Ukraine-Russia war and its impact is, in a sense, playing out. China is beginning its recovery. Inflation projections are being lowered. In fact, even your growth projections for FY24 are slightly lower. So which side would you bet on?
So I guess if one has to take a call as to which direction would RBI go henceforth, for us, the direction is pretty clear in terms of what we take away from today's policy, which is that there is another rate hike, which is most likely coming, hopefully in the month of April. The path thereafter, Tamanna, would be slightly unpredictable. So I would completely agree with Indranil as to there are too many moving parts here. And whether anything beyond April at this point in time is visible, I guess probably not. And that is also the reason why the central bank would want to retain that flexibility, would want to be non-committal. I mean, this is something which is not just true for RBI. I would say this is something which applies to every emerging market central bank. They cannot be pre-committed like most of the developed country central banks are. And they would want to retain that flexibility because you don't know what is going to strike you on the currency front. You don't know what is going to strike you in terms of inflation, unpredictability, as you yourself said. So another 25 basis point rate hike with the expectation that RBI would want to remain much more data dependent and much more non-committal than giving any signs of a shift in policy stance.
Take a look at growth projections and whether there will be mitigating factors there as well. Indranil Pana, I'll start with you. So for 23-24, the growth projection is at 6.4%. It's, I think, largely in line with most global agencies, though the IMF, etc., is looking at 6.1%. What are the challenges on the outlook for India's growth in the next financial year, in your view?
One, obviously, is the export growth and what is the extent of drag that we experience. Second, if global rates were to tighten much faster than we are currently expecting, it could have its implication in terms of dollar flows into India, which is much needed in terms of retaining that flexibility so far as liquidity is concerned. So that's also quite important in terms of the growth projections going forward. Third, of course, there is a clear assumption that has been made by the Reserve Bank of India and also as per the economic survey that the domestic demand is likely to strengthen from here on. So there could be a lot of moving pieces, uncertainties in terms of the monsoon, in terms of the overall pull that the rural segment can actually see from here on. and the extent to which the discretionary spending, especially with respect to the contact-intensive services, some part of it was definitely a pent-up demand, how far it actually continues into 2023 and beyond. So these are some of the factors that will remain relevant for growth. From a domestic perspective, and a certain portion will also be relevant from a global perspective.
Madhvi Arora, we know that interest rate hikes start showing their impact with a bit of lag. Are we beginning to see the impact of these 6 consecutive interest rate hikes now on growth going forward, or there's less of a concern there?
So I think, as you rightly said, it comes with a lag, and we are seeing the impact of it definitely on at least on the demand side of the economy, be it the rural sector or the urban sector. We're also seeing the impact on the formal sector employment growth, which is actually reducing on a consistent basis for the last 4 months or so. So I think, and of course, the investment demand impact will also be visible in private sector. So I think even if it comes with a lag, it's a matter of time that these demand curbing monetary policy moves would start having a decisive impact on the domestic demand in general, even though the external demand would remain a little bit patchy given the fact that we are looking at a slowdown in global markets as well. So I think at this point, you still are seeing a little bit of mixed indicators, but at least the trend, if you remove the noise, is looking to be more towards a correction than towards a more optimistic view that the Reserve Bank and the Government of India are carrying at this point in time.
Vivek Kumar, your take on that. Are we going to see sort of a chilling effect on this domestic demand that everyone is hinging the optimism on right now, because the interest rate hikes, the consecutive interest rate hikes will eventually kick in?
Absolutely right. So the impact of monetary tightening has to be felt, and it typically takes anywhere between 4 quarters to 6 quarters to have that kind of an impact. So FY24 will be the year when you will see the impact of past rate hikes trickling down on some of the real economic activity indicators. Now, having said that, Tamanna, I also have a slightly different view with respect to the external sector. So while yes, there is this popular perception that the external sector is going to weigh down upon India's growth prospects. Now, if you look at it from the growth identity perspective, then the net export sector, and look at where the market is projecting the current account deficit, everybody in the market expects current account deficit to moderate in FY24 vis-a-vis FY23, the current financial year. So a moderation in your trade deficit or a moderation in your current account deficit is normally synonymous with lesser drag on GDP growth. So external sector is a drag on GDP growth. If the drag is lower, if the deficit is lower, the drag is going to be lower. So while yes, exports will take a hit in the next financial year, there's no doubt. But at the same time, there is also an expectation that imports are going to moderate. So net, the external sector probably would be less of a drag in FY24 than FY23. Now that is one part. The other part is that we are also not taking into account what the fiscal policy is doing, because the fiscal policy gradually has been consolidating. And if you look at the statement of intent presented by the finance minister on the 1st of Feb, then the total expenditure is assumed to grow by just about 7.5%. If you adjust it for inflation, there is hardly any growth. So net, I guess, while you could argue that the government is doing a lot on capex, but capex does not impact growth in the short term. Capex is more a medium-term growth story.
Absolutely.
From a FY24 perspective, the slowdown in the pace of government expenditure will also have some bit of bearing. So this is besides the monetary equation, and add to that the geopolitics, which you alluded to earlier. The uncertainty remains in the form of Russia-Ukraine crisis simmering, although to a large extent the on the ground impact is ebbing because supply chains are slowly adjusting to the new normal. I guess the new normal is nothing but shocks getting repeated every couple of years.
Okay.
So yes, in the broad takeaway, growth probably will moderate. Whether it moderates to 6.4% as what the RBI is saying. So 6.4% also happens to be right in the middle of where the economic survey expects the growth to be. And our expectation is slightly conservative. We are at 6%. So more, I would say, in line with where the consensus view is.
Right.
The professional forecasters survey also says that 6% is the median forecast for FY24.
All
So
right.
maybe 30-40 basis points of downside.
The
can be
Econ
expected
survey in that
RBI.
sense has played it safe. There's an 80 bips width.
Oh yes,
Difficult
that's
to go
an
wrong with that.
unusually wide range.
Yeah, difficult to go wrong
Unusually
with that.
wide range.
All right. So, that's where the economy is heading. The large message, if I had to encapsulate very quickly, we don't quite know what's going to happen through the next financial year. Inflation, at least core inflation, that's non-food, non-oil, remains to be a bit of a concern. The impact of all of these consecutive rate hikes is going to kick in and impact demand. That in turn may impact growth as well. So those are the broader sort of brush strokes for the economy. So I want to thank all of you on this. But before we wrap up this segment, we want to talk about what this means for you if you pay an EMI. Clearly, this is not going to be easy on your pocket. By now, you've already seen a bulge in the EMI you pay every month in your home loan, or the tenure of it, as in you must be paying your EMI for much longer. What does this latest hike mean? My colleague Kavita Thapliyal breaks it down for you.
All right, so it's a 25 BPS rate hike as expected, but what's going to be the impact on your home loan and your auto loan? Let's break this down for you and let's compare it as compared to last year. How much more are you paying for your EMI this year? So here's a scenario for you where there is a home loan you've taken on 50 lakhs and the rate was 6.75. Last year in May 2022, it was 7.15%, the overall rate hike or the overall interest rate that you had to pay on your home loan. But then now after 25 BPS rate hike, 9.25 is the rate that you are paying on your home loan. Let's look at the EMI amount. EMI amount, when your interest rate was around 6.75, your EMI was around 38,000, but then look at the way it's gone up 45%, and after this rate hike of 25 BPS, the approximate amount that you might have to pay on your EMI is 45,793. Now, this is the scenario in home loan, but then what about your vehicle loan? Let's get you the auto loan numbers also. Now, for example, if you've taken an auto loan and a 5 lakh auto loan, and the previous year rate hike was 40 BPS and this year after 25 BPS, you can see the amount that has gone up. The interest rate from 9% has gone up to 11.1%, and look at the interest rate hike, almost 30.6%, and your interest and your EMI amount right from 15,900 has gone up to 16,393 this year. So definitely this rate hike has an impact on your EMI, on your pocket. But then what also you need to consider is a lot of banks have stopped increasing the tenure. So if at all you were expecting some kind of relief from your bank by increasing or raising the tenure of your entire home loan, that might not be helpful. You have to sit with your bank and figure out a way, or the only option left for you is to raise your EMI amount.